Should you buy Bitcoin or a Bitcoin ETF? A question that many potential investors are grappling with. Today, we'll take a deep dive into this topic. Let's start with Bitcoin. Born out of the 2008 financial crisis, Bitcoin emerged as a revolutionary concept that changed the landscape of the financial world. Being the first of its kind, Bitcoin holds a unique place in the realm of cryptocurrency. Created by an anonymous person or group of people using the pseudonym Satoshi Nakamoto, Bitcoin came into existence as a reaction to the instability of traditional banking systems. The defining characteristic of Bitcoin, and indeed all cryptocurrencies, is its decentralized nature. This denotes that Bitcoin operates without the oversight of a central authority or government. It isn't tied to a particular nation or subject to its financial regulations. This decentralization is achieved through a technology known as blockchain, a public ledger where all transaction data from anyone using Bitcoin is gathered and stored in an open, transparent manner. This blockchain is maintained by a worldwide network of computers, or miners, who validate and record transactions. In the years following its creation, Bitcoin has received significant attention worldwide. Its extreme volatility, characterized by dramatic price swings, has attracted a myriad of investors looking for high-risk, high-reward investments. As of now, Bitcoin stands as a titan in the cryptocurrency market, with its value reaching soaring heights and dipping to significant lows. This volatility, while risky, has made Bitcoin a captivating investment for those undeterred by the potential for loss. Now let's shift gears to Bitcoin ETFs. The acronym ETF stands for Exchange Traded Fund. A Bitcoin ETF is essentially a fund that tracks the price of Bitcoin. Unlike direct Bitcoin investment, when you invest in a Bitcoin ETF, you're not buying Bitcoin itself. Instead, you are purchasing shares in a fund that owns Bitcoin. This provides a more conventional route for those wanting to invest in Bitcoin, but may not have the knowledge or wish to engage with digital wallets or cryptocurrency exchanges. The primary difference between investing in Bitcoin and a Bitcoin ETF lies in the concept of ownership. When you invest directly in Bitcoin, you are acquiring a piece of the digital currency. You hold a fraction of a Bitcoin and can use it as a medium of exchange or a store of value. However, when you invest in an ETF, you own a share of a fund that owns Bitcoin. You don't hold Bitcoin, instead you hold a financial product that follows the price of Bitcoin. Bitcoin ETFs serve a crucial role in bridging the gap between traditional investing and the relatively new world of cryptocurrencies. They offer the opportunity for investors to gain exposure to Bitcoin without needing to comprehend the complexities of buying, storing, and securing the cryptocurrency. Bitcoin ETFs strive to bring Bitcoin into the familiar domain of traditional investing, making it more accessible and approachable to a broader range of investors. Investing in Bitcoin versus a Bitcoin ETF comes with its own set of advantages and disadvantages. With direct Bitcoin investment, there's potential for astronomical returns due to its volatility. However, this also means higher risk and the need for a deeper understanding of the cryptocurrency market. On the other hand, Bitcoin ETFs provide a less risky and more traditional investment vehicle for those interested in the price movements of Bitcoin without the intricacies involved in owning the actual cryptocurrency. Now that we have an expanded understanding of Bitcoin and Bitcoin ETFs, let's delve into the pros and cons of each. Bitcoin, the pioneer of cryptocurrencies, has its unique advantages. As the first of its kind, Bitcoin laid the groundwork for thousands of other digital currencies, yet it continues to stand out amongst the crowd. But what makes this digital asset so appealing to investors, and why has it gained such a dedicated following? In order to fully understand this, must delve into the myriad of pros offered by this revolutionary digital asset. The first and arguably the most potent appeal of Bitcoin is its potential for high returns. Since its inception in 2009 by an anonymous entity known as Satoshi Nakamoto, Bitcoin has seen a meteoric rise in value. This digital currency started off as an obscure concept, barely worth anything, but has since transformed some early adopters into multimillionaires. It's an incredible rags-to-riches story that has captured the imagination of many an investor. From initial investors who purchased Bitcoin for mere cents to those who entered the market later, many have reaped incredible returns. The year 2017 is a prime example of this ascension, as Bitcoin reached its first significant peak, practically becoming a household name globally. The frenzy around this digital currency as prices soared, hitting nearly $20,000 by the end of the year. Since then, it has continued to hit new highs, showing moments of volatility but generally maintaining an upward trajectory. This growth pattern presents a tantalizing prospect for investors seeking significant returns on their investments, where the potential income can far outstrip traditional investment avenues. Next, Bitcoin's decentralization is a key factor in its appeal. Unlike traditional currencies, which are controlled by central banks and linked to specific countries or regions, Bitcoin operates on a global peer-to-peer network. This decentralized nature means it's not subject to government regulations or monetary policies that could potentially destabilize or devalue it. It is, in essence, a form of people's currency, untethered by the whims of any single authority or geographical location. This decentralization extends to way transactions are processed, bringing with it a degree of anonymity. Unlike traditional banking methods where transactions can be tracked and traced, Bitcoin transactions are pseudonymous. This makes transactions more private, providing an additional layer of security and privacy for users. For some, this aspect of Bitcoin is particularly attractive, as it allows for a level of financial independence not granted by traditional banking systems. Another major advantage is the control and security Bitcoin offers. When you invest in Bitcoin, you have direct ownership of your digital assets. This is not the case with traditional banking, where you entrust your money to a bank or a financial institution. Instead, your Bitcoins are stored in a digital wallet, which only you can access with your private keys. This gives you full control over your investment and reduces the risk of third-party mishandling. You become your own bank in a sense, and this level of control is something that many investors find appealing. Finally, Bitcoin is a truly global and borderless currency. It can be sent or received anywhere in the world, at any time of day or night, without the need for currency conversions or international transfer fees. This makes Bitcoin particularly attractive for international transactions and for people living or working in countries with unstable currencies or restrictive financial systems. It's a digital passport of sorts, allowing you to move money across borders with ease, something that is not possible with traditional currencies. To sum it all up, Bitcoin's unique combination of potential for high returns, its decentralized nature, direct ownership control, and global accessibility make it a compelling investment option. It presents an opportunity for investors to diversify their portfolios and possibly achieve significant returns. However, like with any investment, there are risks involved. While the benefits are indeed alluring, it's only fair we also explore the downsides of investing in Bitcoin. Despite the potential for high returns, investment in Bitcoin carries its own risks. Cryptocurrencies, the most famous of which is Bitcoin, have become a popular investment choice for many. However, before diving headfirst into the world of Bitcoin investment, it's important to understand the risks that come with it. Let's take a deep dive into these potential pitfalls in order to give you a comprehensive understanding what exactly you're getting into. Firstly, let's talk about the high volatility of Bitcoin. This is the most well-known risk associated with Bitcoin investment, and with good reason. The price of Bitcoin can fluctuate wildly in a matter of hours, even minutes. This makes it a very unpredictable investment. To give you an idea of just how volatile Bitcoin can be, let's look at an extreme case. In December of 2017, the price of Bitcoin skyrocketed to nearly $20,000. However, just a year later, in December of 2018, the price of Bitcoin had plummeted to under $4,000. That's an 80% drop in value in a year. Such volatility can spell disaster for investors who aren't prepared for these rapid price swings. If you're not constantly monitoring the market and timing your investments perfectly, you could stand to lose a significant amount of money. Next, we have regulatory risks. Cryptocurrencies, including Bitcoin, exist in a largely unregulated environment. This is due to the fact that cryptocurrencies are a relatively new phenomenon, and governments around the world are still figuring out how to manage them. The rules and regulations surrounding cryptocurrencies are constantly changing, and this lack of regulatory clarity can make it difficult for investors to navigate the Bitcoin market. For instance, 2018, the Indian government banned banks from dealing with. This caused a significant disruption to the market, and many investors were left in the lurch. It's important to understand that if you choose to invest in Bitcoin, you're essentially stepping into uncharted territory, and you need to be prepared for the regulatory that come with it. Another major concern when it comes to Bitcoin investment is security. Bitcoin transactions are irreversible, meaning that once you've sent your Bitcoins, there's no getting them back unless the recipient decides to return them. This means that if you send your Bitcoins to a scammer, you have no way of retrieving them. Furthermore, Bitcoin is stored in digital wallets, making it susceptible to hacking. If a hacker manages to get access to your private keys, they can steal all of your Bitcoins. There have been numerous high-profile hacks, like the infamous Mt. Gox hack in 2014, where around 740,000 Bitcoins were stolen. This illustrates the potential security risks that come with Bitcoin investment. Lastly, we need to discuss the lack of consumer protection. If your Bitcoins are stolen, there's no insurance to cover your losses. Unlike traditional banks, which are insured by government entities like the Federal Deposit Insurance Corporation in the United States, Bitcoin doesn't offer such safeguards. This means that if something goes wrong, you're essentially on your own. This lack of consumer protection is a significant downside to Bitcoin investment, and it's something that all potential investors should take into account. In conclusion, while Bitcoin investment may offer the potential for high returns, it also comes with a fair share of risks. High volatility, regulatory uncertainty, security risks, and a lack of consumer protection are just a few of the potential pitfalls. Understanding these risks is essential before you make the decision to invest in Bitcoin. So while the allure of high returns may be tempting, it's important to remember that with reward comes great risk. Now, let's shift our focus to Bitcoin ETFs. Bitcoin ETFs offer a different way to invest in this revolutionary digital currency. You might ask, what are the benefits of such investment? Let's take a closer look. One of the most significant advantages of investing in Bitcoin ETFs is their relative ease of access. In the world of cryptocurrencies, buying Bitcoin directly can be a daunting task, one that often necessitates owning a digital wallet, a certain amount of technical know-how, and a strong tolerance for risk associated with the ever-fluctuating value of cryptocurrencies. In contrast, Bitcoin ETFs are a more user-friendly and accessible route for investors, beginners, and seasoned investors alike. Bitcoin ETFs operate like any other exchange-traded fund, which means you can purchase them just as you would any other stock or bond. They can be bought through your regular broker or even in your retirement account. This democratizes the process, eliminating the need to grapple with the complexities and potential risks of direct cryptocurrency exchanges. Another major advantage of Bitcoin ETFs is the diversification of investment. Despite its name, a Bitcoin ETF doesn't exclusively invest in Bitcoin. Instead, it also includes investments in other related areas. These may include tech companies heavily involved in the development and enhancement of blockchain technology, or even other digital currencies. By diversifying the investment portfolio, a Bitcoin ETF takes a more holistic approach to the world of digital assets. This means that even if the price of Bitcoin experiences a downturn, your investment could still be buoyed by the performance of the other assets within the fund. This strategic diversification, in turn, can help reduce the risk associated with the extreme volatility of Bitcoin and other cryptocurrencies. It is a method of spreading out the risk and potentially increasing the positive return on investment. Bitcoin ETFs also offer an additional layer of security through regulatory oversight. Unlike the world of cryptocurrencies, which is largely unregulated and where malpractices can be rampant, ETFs are strictly regulated by financial authorities. They must adhere to a comprehensive set of rules and regulations designed to protect investors. This is a stark contrast to the somewhat shadowy world of cryptocurrencies, where scams and fraud can be all too common. By providing a pathway to invest in Bitcoin's potential without actually owning the cryptocurrency, Bitcoin ETFs carry significant appeal for those interested in the potential returns of Bitcoin, but who may be uncomfortable with the idea of owning a digital currency. This presents a more palatable method of dipping a toe into the cryptocurrency waters without having to fully immerse oneself in it. Lastly, there are potential tax benefits to investing in Bitcoin ETFs. When you sell your shares in a Bitcoin ETF, you're subject to capital gains tax, but only at the point of sale. In contrast, if you were to buy and sell Bitcoin directly, each individual transaction could potentially be a taxable event. This means that you could experience a tax liability each time you make a transaction, adding another layer of complexity and risk to the direct handling of cryptocurrency. Bitcoin ETFs, on the other hand, can offer a more tax-efficient way to invest in Bitcoin by allowing you to control when you pay your capital gains tax. Despite all these advantages, it's essential to remember that all investments carry a level of risk, and Bitcoin ETFs are no exception. As with any investment venture, careful research and consideration should go into each step towards investing in Bitcoin ETFs. But just like Bitcoin ETFs are not without their drawbacks. Before you dive into Bitcoin ETFs, it's crucial to understand the potential downsides. The world of investments is a complex and multifaceted one, where understanding the potential pitfalls is equally as crucial as recognizing the possible gains. It's like a game of chess, where every move can lead to a win or a loss, and you ought to know the rules and the strategies to make the right moves. When it comes to the burgeoning field of Bitcoin ETFs, there are a plethora of potential cons that you should be apprised of, and we'll delve into them in detail here. Firstly, let's discuss the fees. Like any organism in the financial ecosystem, Bitcoin ETFs don't exist in a vacuum. They come with various attached costs that can gnaw at your potential profits, much like termites eating into a wooden treasure chest. These expenses include management fees, which are levied by the fund manager for the task of overseeing the ETF. It's like a gardener tending to a precious plant, ensuring its optimal growth. However, this care comes at a cost. There might also be brokerage fees you'll need to contend with. These costs accrue when buying and selling shares in the ETF, much like a toll you pay on a highway. Over time, akin to small drops forming a large ocean, these costs can stack up and significantly impact your returns. It's like a stealthy creature that slowly drains your resources if not kept in check. Secondly, there's the potential for what's known as tracking errors. The primary goal of Bitcoin ETFs is to mirror the performance of Bitcoin. However, sometimes they may falter in this task, much like an actor forgetting a line during a performance. This discrepancy between the ETF's performance and the actual performance of Bitcoin is known as a tracking error. Sometimes these errors can be beneficial, like a lucky draw, but other times they can lead to underperformance, akin to a runner lagging in a race. It's crucial to understand that investing in a Bitcoin ETF does not guarantee that you'll match the strides of Bitcoin itself. Yet another downside is the lack of ownership control. When you purchase a Bitcoin ETF, it's important to remember that you're not actually buying Bitcoin. It's like buying a ticket to a concert and not the concert itself. Instead, you're acquiring shares in a fund that owns Bitcoin. This means you don't have the same level of control as if you owned the star performer directly. For instance, you can't spend your Bitcoin ETF shares as you would actual Bitcoin, nor can you transfer them to a digital wallet for safekeeping. It's akin to owning a picture of a Ferrari rather than the Ferrari itself. The control you have is limited, and that's a crucial aspect to consider when diving into the world of Bitcoin ETFs. Finally, it's worth noting that Bitcoin ETFs are subject to regulatory risk. In the ever-evolving world of cryptocurrencies, governments around the globe are still figuring out how to rein in this wild stallion. These changes in regulations could have a profound impact on the value of Bitcoin ETFs. It's like the changing tides, which can influence the direction of a ship at sea. With all this, you might wonder, which is the better investment? As with any pivotal decision in life, the answer depends on your individual circumstances, risk tolerance, and investment goals. It's like choosing a path at a crossroads, each leading to a different destination. Always arm yourself with knowledge, do your research, and consider seeking advice from an astute financial advisor. It's like embarking on a journey with a reliable guide, ensuring that you're on the right path. Bitcoin and Bitcoin ETFs each come with their own set of advantages and disadvantages. This discussion is pertinent, considering the growing interest in digital currencies and their effects on the market. So let's delve deeper and explore the intricate dynamics between Bitcoin and Bitcoin ETFs. The choice between these two ultimately depends on your individual investment goals and risk tolerance. These parameters should guide every investment decision you make, and understanding the specific risks and rewards associated with Bitcoin and Bitcoin ETFs is crucial. Now, let's circle back and sift through the detailed pros and cons we've discussed to help you find your footing in this digital finance landscape. Embarking on this journey can be challenging, but understanding the benefits and drawbacks of both options can significantly simplify it. Investing in Bitcoin directly gives you complete control and ownership of your assets. This ownership is not just figurative, but represents a tangible control over your investments. It's akin to holding physical gold in your hand, with the key difference being that Bitcoin is digital, a modern version of the precious metal, if you will. You're free to use, transfer, and store it as you please, giving you unparalleled freedom and control. This level of autonomy is a significant draw for investors, especially those who value control and independence in their investment decisions. However, with this freedom comes responsibility. You're solely in charge of the security and management of your Bitcoin. This might seem easy, but it's a daunting task, especially for those not tech-savvy. It involves managing digital wallets, understanding blockchain technology, and staying updated on digital security threats. This responsibility can be a significant burden, and one that requires a certain degree of technical expertise. On the flip side, Bitcoin ETFs offer a more traditional investment route. Think of it as buying shares in a company that owns Bitcoin. This method gives you a more passive role in your investment, which can be a relief for many who are not comfortable with the technical aspects of managing Bitcoins. You get exposure to the price movements of Bitcoin without the need to manage the cryptocurrencies yourself. This comes with the added advantage of being able to buy and sell your shares through traditional brokerage accounts. This ease of transaction represents a significant draw for many investors, particularly those accustomed to the more traditional forms of investment. However, as with any managed fund, there are associated fees. These fees can eat into your potential returns, especially when compared to owning Bitcoin outright. These costs might seem minor initially but can accumulate significantly over time, potentially reducing your net returns. Now, let's talk about risk tolerance. Bitcoin, often dubbed the poster child of cryptocurrencies, is known for its price volatility. One moment it's skyrocketing and the next, it's plummeting. This roller coaster ride can be nerve-wracking for some investors, especially those with a low risk tolerance. If you're someone who prefers stability over high-risk, high-reward scenarios, Bitcoin ETFs might be a better fit for you. They tend to be less volatile than Bitcoin itself, thanks to their diversified portfolios and regulatory oversight. This stability can provide a sense of security to investors and make Bitcoin ETFs an attractive option. Speaking of regulations, Bitcoin operates in a somewhat gray area, with its legal status varying significantly across the globe. This ambiguity can lead to potential and financial risks, which can be daunting for many investors. Bitcoin ETFs, on the other hand, are regulated financial products. They offer a layer of protection and transparency that you won't find with direct Bitcoin investments. These regulatory safeguards can significantly reduce the potential risks associated with Bitcoin investments. In conclusion, the decision between Bitcoin and a Bitcoin ETF boils down to your personal investment strategy. If you're a hands-on investor who's comfortable with high-risk scenarios and tech-savvy enough to manage digital assets, Bitcoin could be your golden ticket. Alternatively, if you favor the familiarity of traditional investment avenues, value stability, and prefer having professionals manage your assets, a ETF might be more your speed. Remember, whether you choose Bitcoin or a Bitcoin ETF, investing always comes with risks. It's essential that you understand these risks and factor them into your investment strategy. Always do your due diligence and consult with a financial advisor before making any investment decisions.